Welcome back, ladies and gentlemen. Thank you all for joining me today. I'm so glad you're here on the channel because today we're going to be taking a look at the quarterly earnings for Q2 2022 for Dropbox. Now, the ticker symbol on that is DBX, and I'm trying to go through all of my portfolio and show you all the quarterly earnings as a way of forcing myself to sort of look at the earnings and make sure that I read everything over, as well as be able to show you something about the company and give you my thoughts and everything that I'm looking at when I'm looking at these earnings and the transcripts. Now, one of the crazy things is that for you, you get to, suggest anything down below if you go into the comments. If you ask for a company or ask for something specifically, if I can, I'll try to, include it into a video. So if you're interested in that, make sure to leave a comment down below. But with that being said, make sure to subscribe and like, and let's dive right into this video. So I'm going to be going through the earnings release, that earnings report that they released, and then as well as the transcripts, and then I'm kind of going to touch on their investor presentation because there's some things in there I wanted to touch on. But a lot of this kind of overlaps, so I'm going to try my best not to do, a bunch of the same thing. So first things first, some of their great notes from Q2 2022 was that second quarter revenue of 572.7 million is up 7.9% year over year. Constant currency basis, that's 8.8% year over year. And again, you see this like the currency for the United States really impacted a lot of companies. We mentioned it with Meta Platforms, and it clearly happened Dropbox as well. Their GAAP operating margin was 14.5%, non-GAAP operating margin 31.9%. Net cash provided by operating activities 209 million, and then free cash flow was 205 million. So, but one of the big things is that Drew Houston, who is the CEO of Dropbox and really one of the founders, and that's why I love this company so much, was that he really likes it how well they've been performing in this macro environment, and he said this. So our Q2 quarterly results are a testament to the strength of our business, the value of our product delivers to our customers despite unpredictable macro environment. We made great progress this quarter, enhancing performance and functionality in our core FSS product, releasing additional security and data protection capabilities, expanding workflows like capture and replay. We believe we're operating from a position of strength due to deliver value to shareholders, thanks to strong profitability and improved customer retention. I'm proud of the team's discipline and execution, excited for what's ahead, and as we build one organized place for your cloud content and all the workflows around it. So he loves how he performed in the quarter, which is great. Again, here are some of the quarterly results. So you got the revenue, as I mentioned, the total ARR, or the annual recurring revenue, ended at 2.33 billion, an increase of 43 million quarter over quarter, increase of 7.7% year over year. Constant currency was 8.3%. Paying users ended at 17.37 million as compared to 16.14 million for the same period last year, which is great because that's what's supporting that average recurring revenue, is the fact that they're introducing and upselling more paying users. So that's really what you like to see. Average revenue per user is $133.34 as compared to $133.15 for the same period. They walk through why that didn't move as high, and it really has to do with the way that their family plans work, because it's technically 6 people under one plan, and a lot of people are using family plans right now. So it's going to impact their numbers for the ARPU at least, and that's why you didn't see it move as much. Now, GAAP gross margin was 81.5% as compared to 79.8%, and the non-GAAP margin was 83% as compared to 81.2%. Other than that, their net income's finally positive this year. If you remember, if you don't know anything about Dropbox, when COVID happened, had impaired a lot of their real estate because they didn't need it anymore. They switched to a virtual first kind of workplace, and they are subleasing some office spaces and things for people, but they, for the most part, had to get rid of a lot of their real estate down in San Francisco. So their GAAP net income was 62 million as compared to 88 million for the same period last year. Non-GAAP net income was 138 million as compared to 160 million. The company's GAAP and non-GAAP net income declined year over year as a result of significant income tax expense due to the impact of new R&D tax legislation. The net cash for operating activities, again, is 209, and their free cash flow is 205. You're seeing some, basically it's growing on the top line. It's kind of flat on the bottom line and some of the other lines of the income statement. which I'm totally okay with at this point where we're in this macro environment. I'm totally okay with that. So they ended with cash and cash equivalents of 1.446 billion. And then it's just sort of some of the other points that they had here on the statements. So again, you're going to see here, it mentioned the revenue is growing just a tiny, just tiny bit. Um, as far as the 6 months here on the right, they're a tiny bit above where they were in the 6 months of 2021. So that's totally fine with me too. They're putting a lot of, you know, expenses and things through. So a lot of that's going to start showing. And they're also, you know, trying to build out and price out a lot more of this. They're actually increasing the price of some of their plans. As far as their assets and things go, their cash and cash equivalents is down a little bit because they're buying back a lot of their shares. So you're going to see sort of the cash and cash equivalents go up and down as we go forward. Their liabilities really didn't go anywhere. I mean, difference of, what is that, 84 million maybe? It didn't really go anywhere. This convertible notes is really what's driving a lot of that. It's 1.3 billion convertible notes. So make sure you're paying attention to that. I really would like them to pay that down at some point, but they're kind of using all that cash that they have to buy back their shares and sort of reward shareholders in that way. So that's kind of why their assets are going down, but their liabilities aren't going too far down at all. Other than that, you're going to see sort of their free cash flow, so you got your net cash operating activities. So this is going to be from your quarter on the left side and then your 6 months on the right side. They're not really putting a lot of money into CapEx right now. They are, you know, they're interested in CapEx and they're interested in M&A. So we may see something come through. Drew Houston talks about it in the transcript. The fact that they're seeing multiples come down for M&A, that it's possible. I mean, if they find the deal that they like and they find, you know, something that they feel like would be a good addition to their business, that they would, you know, add it onto their portfolio of things that they offer. So other than that, on the earnings release, just here's the free cash flow and how they calculated it. Now, they are doing a lot of stock-based compensation. So if, you know, some people like to add that into the free cash flow calculation as well. I'm just going to show you what they have on theirs, but you know, it's something to note because, you know, the CapEx is 4 million maybe. Stock-based compensation might be a little bit higher. Um, it's a lot higher actually. Yeah, because look, the stock-based compensation is right here. So CapEx was 4 million, stock-based compensation is 85 million. They are buying back a lot of their shares if you take a look right here. So they've bought back $189 million worth of their shares for the quarter. So it's offset somewhat, but still something to note that they're, you know, using SBC and that some people like to include that in their free cash flow calculation. Now jumping on over to the transcript, there's just a couple of things that I wanted to go over. Both the, you know, the prepared statements from Drew Houston and the CFO, along with, you know, the questions and answers that they do at the very end. So here's one of the things that he kind of opened with when Drew Houston was going through. So I'll start with how we're evolving our core business. Consistent with last quarter, we once again saw an overall churn rate fall year over year. This was a result of ongoing improvements to the core FSS user experience, particularly on mobile. For example, we enhanced the mobile uploads experience for our users, driving significantly faster speeds on our iOS app, which led to nearly double the percentage of active users on the app who upload content compared to a quarter ago. We also improved the performance and design of the Photos tab in the mobile app, which increased the overall numbers of photos previewed on our mobile experience by 10% since the start of the year. This builds on the work we talked about last quarter about driving performance with previews on the web. So this is kind of one of the things that they touch on too, is that where Dropbox kind of fits in this cloud ecosystem, because when you think what their competition is like Google Cloud, AWS, Apple, there's just a bunch, and Box actually is in there too. There's a bunch of different companies offering different kinds of things, and so they're trying to position themselves as sort of, you know, this catch-all for everyone. And so one of the things that they focused on this sort of last quarter was a lot of mobile and making sure that mobile works really well so that people can upload and download photos really easily, especially people who are like content creators and things like that can use Dropbox to send videos and receive videos if needed in a very easy fashion. So sending videos and receiving videos on Dropbox is a lot easier now when you're using mobile. So that was kind of one of the things that they had touched on. The other thing that they had was HelloSign, which is their e-signing document, part of the business. So he said, HelloSign continues to show solid growth despite moderating following the pandemic surge, consistent with broader e-signature space. And you've seen that with DocuSign. DocuSign fell off a cliff, fell off the mountain. I don't know what you would call it. DocuSign is down a lot. He said, we saw a greater mix shift towards higher price plans as well as healthy upsell on the HelloSign API. This is an opportunity to continue to differentiate HelloSign as we enhanced our offering to improve a developer's ability to explore and build with our API. So this is kind of one of those things too. Again, I mentioned it when I did my Dropbox video. If you want to see that, I'll link it either in the card or it'll be linked down below. But the ability for you Dropbox to integrate with a lot of its partners and for people to kind of it's a lot more open than I feel like a lot of other companies have with their products. And that's one of the great things is the fact that you can make it more customized, you can make it yours, which I think a lot of people really like about Dropbox. Now, Tim Regan, he had mentioned we exited the quarter with 17.37 million paying users, added approximately 280,000 net new paying users in the second quarter. Average revenue per paying user was again $133 in Q2. ARPU decreased by $1.29 compared to Q1, primarily due to the foreign exchange rate headwinds and continued strength from Family Plan, and I mentioned that earlier, which as a reminder is comprised of 6 seats and therefore carries a lower ARPU profile. So really what this means is just that they take like the total average revenue and then divide it by however many paying users that they're using, and they average that out. So it's gonna, as you know, if you're paying for a family plan, there's 6 seats and 6 people sign up using those seats, it's gonna drive your ARPU profile lower. That logically makes sense. So, but I'm glad that they kind of pointed out why the ARPU looked a little bit lower. So for full year 2022 guidance, or really sort of their guidance for the year. So they said, finally, we expected diluted weighted average shares outstanding to be 360 million to 365 million shares based on our trailing 30-day average share price. For the full year 2022, due to significant strengthening of the US dollar since our last update, we were revised as reported revenue guidance range down by 12 million. So it's going to be 2.308 billion to 2.318 billion versus 2.32 billion and 2.33 billion. However, on a constant currency basis, we were revising our guidance range up by 8 million, and then up from the prior range of 2.334 to 2.344. So again, this whole foreign exchange is really impacting a lot of businesses. It's kind of crazy to me as I've been reading through other earnings reports, how many people are mentioning the foreign exchange and how much it's impacted their numbers. But he said we're maintaining a free cash flow guidance to be in the range of 760 million to 790 million. And again, their long-term goal by 2024 is to have $1 billion in free cash flow, that's a hefty goal. They've got 250 million to go, or really 200 million to go pretty much. So it's going to be interesting to see how they do this. But I'm along for the ride. It's going to be very exciting. Said finally, we expect 2022 diluted shares outstanding to be in the range of 364 million to 369 shares, down from our previous guidance of 366 million to 371 million shares. This reduction in our share count reflects our commitment to an anticipated impact of our share repurchase program. So they're going to be buying back a little bit more shares than they had originally guided for. That's totally fine with me. I really like to see that. So hopping on over to the Q&A session, you had Richard Pullen, and again, this is pulled from Seeking Alpha, so if there's something, if the English doesn't make sense when you're reading this, it's because of the way that the transcripts are, taken, so I'm sorry ahead of time, but he said, so it looks like about 20% price increase. So this is the first time they're going to increase the price since 2017. So it seems reasonably, but you talked about receiving early positive signals on the pricing change. Maybe talk about any potential impacts you're maybe assuming on in terms of monetization or renewals on this, and then you can give us a sense of linearity over the next 12 months of the moving subscribers to the new pricing. So Tim Regan said, I'll take that one. So we did raise prices for the plans by 20%. These are standard and advanced team plans, which we have not changed these prices since 2017. Again, for new customers, these began to have the higher price plans starting in June. And for existing customers, they begin renewing at a higher price point starting in July. The subset of our user base that is subject to it compromises about a third of our ARR. So they're going to be upping their prices for the advanced and standard teams plans. And what that really means is that their revenue should trend higher, assuming they don't have a bunch of users drop. So it'll be interesting to see next quarter what that all looks like, because they're going to pretty much from about now to when their next quarterly earnings are, they're going to start seeing the impacts of that a lot more, especially in Q4, as that kind of flows through. So the way that their revenue recognition works is that, they get paid, let's say they get paid an annual amount, and they kind of have to recognize that as the quarter goes on, because just because they receive the amount doesn't mean that it's, automatically taken to the revenue line. So you'll kind of see that as the quarters go on, you'll see that increase in price sort of get added on. Um, so you'll see where he mentions it here. He says, as a reminder, we will see a benefit of pricing change flow to ARR. Customer billing cycles occur with monthly customers flowing through in the first month of the change. And then given our ratable revenue recognition model, the revenue impact will flow through to both 2022 and 2023. So maybe one other point along those lines, just to give you a sense of the timing, is that our annual customers tend to represent about 2/3 of our customer user base, whereas only monthly customers is about obviously 1/3, where the monthly customers will subject to change largely in the third quarter, so therefore we may most expect the impact to flow through in the third quarter. So then for the last point, really the last question, Brent Thill asks, sorry, just on the guidance, what is embedded in your guidance, and ultimately what's maybe not embedded as it relates to within the guide? I mean, yes, you are taking a more conservative view than ultimately what you saw this quarter, same or improving view. Just curious at how you're thinking about through this environment. And Tim Regan said yes. So I'd say our business does remain resilient in this challenging macro environment. As we talked about, we're raising our constant currency revenue guidance for the year by about 8 million or 8.8% at the midpoint. And as far as what's included, the range does not include our mid to high single digit impact from our discontinued services to Russia. As far as what's driving the raise, we're seeing positive early signals on pricing and packaging thus far. Certainly seeing churn rates coming in better than we expected. So clearly the pricing has been factored into our guidance. And again, we're continue to see year-over-year improvement in retention across many different areas like Drew had alluded to. So we're very positive about many opportunities that are in play, including upsell, cross-sell, new products, feature adoptions, growth areas such as DocSend and HelloSign. All of that clearly has been a philosophy perspective. We have no material changes from our historical approach, and we continue to guide to what we have as a high degree of visibility into. So certainly keeping an eye on things like the macro economy, but to Drew's earlier points, we're seeing strength on that front. All of that, of course, is factored into our guidance. So again, their guidance is going to be, it's not going to be a crazy growth story here at Dropbox. It's going to be really just a steady business that keeps climbing, that is integrated into businesses, and that's really a necessary part of businesses. Cloud storage is like a huge component of a lot of businesses. So it'll be interesting to see how this plays out, but I just want to take a look at the investor presentation, show you all what was on there real quick, and then we'll be done with the video. All right, so if you take a look at their investor presentation for the second quarter, here you can see what their product portfolio is, in case you've never seen, what their product portfolio is before. So HelloSign, DocSend, and you got individual and teams, Dropbox, their sort of traditional product. The other thing I wanted to point out was how that they use sort of this, they use this sort of workflow to be able to drive new people. So Dropbox introduces new tools to easily automate and maintain an organized file system. So this is some of the things that people were asking for, that they do as a way for them to be, it's easier for them to sort of organize their folders as they go. So they were able to introduce a lot of these different features. They also introduced some new products. So Capture is an all-in-one visual communication tool that helps team members share their work and ideas asynchronously. So that's going to be really cool to see. Replay is another one of those, a video collaboration tool that makes it easier to collect, manage, and respond to feedback all in one place. So that'll be really awesome too. Again, that's the whole thing, is you want it to all be in one place when you're sort of working on something with someone else, or working through a workflow for your business. It's a lot easier when everything's in one place. You don't have to keep sending things back and forth email wise, and then having to go video and come back. It's a lot easier when it's all there. Now, this was one of the things that I didn't realize that they had come out with this out of beta. So it was in beta for a while, but Shop. So Dropbox Shop actually allows you to set up sort of a home page where you can put either your pictures or digital assets or whatever and sell them. So that'll be really interesting to see how that plays out over the next couple of quarters, years, because I'm not sure if I haven't seen any Dropbox shops yet. But I'm gonna do some digging later and see if I can find anything, because I think it's really interesting that shop is an option now. It could create a new vertical. We'll have to see what that looks like. So other than that, again, as I mentioned earlier, they're long-term targets. You got $1 billion in free cash flow by 2024, non-GAAP gross margin 80 to 82%, and you got non-GAAP operating margin 30 to 32%. So this $1 billion in 2024 is really what I'm looking forward to. If you want to see more of that, go to my Dropbox video. And we really talked about, if you even had like a 12 free cash flow multiple or something. It was like a 12 or 15. Like the upside's still crazy. So as long as the fundamentals, obviously everything remain, I think the $1 billion is doable. But we'll have to see, obviously, the macro environment, everything going on. But I'm curious to see how this all plays out, and I'm along for the ride. So that'll be really cool. Other than that, they just kind of went through different key metrics. So they had their ARR, paying users, ARPU. A lot of this though is it really comes from 2021. They used like the yearly mark, but you can see just sort of some of the quarterly stuff, but a lot of this is really focused on, the year. Um, but I like seeing a little graph like this. So again, ARR, paying users, and ARPU, as we mentioned earlier. And then really other than that is just their sort of model that they're going for. So this is all 2021 numbers, but you can see all their long-term pieces on it. So it'd be nice because it's R&D. As it comes down means as their revenue goes up, they're not going to be upping their R&D expense at all, along with their annual free cash flow, as I mentioned earlier, and their gross margin. So other than that, that's all I got for today. Make sure to stay tuned if you want to see some of the other companies in my portfolio. I'm really interested to hear what you think about Dropbox, hear what you think about the company, and think about the earnings. If you have any other companies that you want me to look into, make sure to leave me a link down below, or not a link, leave me a comment down below, and I'll make sure to take a look at it or at least respond to it. If it's not in my circle of competence, I'll let you know. But with that being said, thank you all for joining me today. Have a great day and happy investing.